Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Shane Galway of Guinness Asset Management to talk about the Guinness EIS Fund. Hello, Shane.
Hello, Alex.
Shane, tell me about Guinness, who you are, and give me an introduction to yourself.
Certainly. So Guinness Asset Management was founded in 2003 by Tim Guinness. We're based here in Westminster in London, and there's 40 of us. We have just over 2 billion under management, of which 200 million is in our EIS funds. I started my career in HSBC in 1996 and first got involved in growth companies back then, which led to a lifelong fascination with investing in growth companies. And I started the Guinness EIS in 2010, so we've done a decade of investing in EIS funds at Guinness.
And tell me about the EIS fund. What's it aim to do for investors? How many companies would you typically invest in?
So our Guinness EIS fund is focuses on scale-up businesses. So these are businesses that have already proved up their service or technology or product to a point where they're looking to scale it up. And so we tend to filter for businesses that have at least £1 million of revenue. We offer investors, we close in tranches through the year. So we have 4 closes through the year. Our next close is on the 18th of December. And we look to give investors a portfolio of at least 10 companies and a diversified portfolio across different sectors. We're generalist investors, so we like to diversify across different sectors.
And you talk about looking for companies with £1 million revenue. What are the other characteristics you're looking for?
Management teams are key. So we look for strong management teams. As I say, it's scale-up businesses that we're focused on. So these are post-revenue businesses that are already generating revenue and looking to expand into other markets or other products. When doing our due diligence, we focus on business plans that can demonstrate good growth, and we actually filter for businesses. We look for a business that can deliver at least 2 times growth over the investment period, and the average is normally about 4 times is our target growth.
And are there any particular sectors you look at?
Yes, so technology and healthcare are 2 that are popular, but also education and leisure, food and drink, manufacturing, retail. So really we invest across a range of sectors. We cover 10 sectors in our current portfolio.
And you mentioned management teams being important. What do you look for in a management team? What makes a good management team?
Well, experience is always very welcome. A clear direction and business plan. Where we can, obviously, many of the management teams we see are young and dynamic, and we can help add to their experience with, for example, help them recruit a chairman or a finance director to bolster management teams. But experience and business plan are 2 areas that we value.
And are there any red flags when you see a management team come to you with a proposal, other things which turn you off immediately?
I think every business presents the best possible future for themselves. So we tend to see part of what we need to do is to pare back the business plan to give a realistic valuation. But unrealistic valuations are perhaps a red flag for us.
So let's talk about the types of companies you invest in. Can you give me a few examples of recent investments you've made?
Certainly. Well, let me pick a couple of investments we made earlier this year. So one is Pasta Evangelist, and that's actually a follow-on from an investment we made last year. And Pasta Evangelist delivers high-quality pasta ordered online through the letterbox to homes, direct to consumers. And perhaps as a beneficiary of the pandemic, they've seen sales rise tenfold this year on last year, and their profile expand significantly. Another business in a very different sector is a company called Biblu. And Biblu offer digital access to university libraries, to students. So they contract with universities and they have agreements with the main publishing houses to offer access to libraries. And of course, with students studying remotely, that has been invaluable, and they've seen very strong demand for their products this year.
And just going on from there, those two companies you mentioned, what made you invest in both of them? What was the thing?
We recognised, interestingly, we've been talking to these businesses before the spectre of COVID arose. With Pastor Evangelist, again, a strong management team, a clear offering, and a clear route to market. They had already established themselves when we invested last year, and they needed capital to help expand that business, which we were able to provide. With Biblio, again, they'd already won contracts with some major universities demonstrating the demand for their products. And so that encouraged us to help them move to the next level. And we've co-invested with a social impact fund and a family office.
And what about the older investments you've made? How are they doing? Maybe you could talk through one which is doing particularly well and maybe one which has done less well.
Certainly. So again, sort of picking out a couple of different businesses. One is Sarah Care, which provides care to the elderly and vulnerable in their own homes. And Sarah Care has seen enormous growth this year. It's grown to over 5,000 carers and an annual revenue run rate of 100 million. So that's been a huge success story for us. Another business, Gravity, which runs trampoline parks around the country, has had to adapt significantly due to the COVID pandemic because many of their sites were shut. But by helping them scale their costs and take advantage of the government assistance, they've been able to navigate those waters. And actually, in the most recent month, they turned over 1.2 million and made $500,000 of EBITDA. So they've been able to navigate the pandemic well.
It's very impressive. And how much do you get involved with these companies?
We like to be involved as part of our investment. We have a very strong portfolio management function headed by Bridget Hallahay, and we take a board seat on investee companies. And as part of our investment process, we usually ask for an investor class of share, and that gives us certain rights and vetoes, and to help ensure that our investors' interests are prioritised or protected as the company grows.
So Shane, let's talk about exits. I know you've had a recent exit, so you can tell me more about that, and also just sort of give investors an idea of when they are likely to get their money back if they invest in your EIS.
Yes, indeed. So we have a 4 to 5 year investment time frame, and since 2016 we've made 8 exits. 7 have been renewables and 1 growth exit under the new rules. The growth exit is from Jones Food Group, which is a hydroponics business, and that is growing leafy greens and salads under LED lights. And Ocado have taken a majority stake in that business and are expanding it significantly.
Just going back slightly, the pandemic, how has it affected you? How has it affected the market in general?
Well, interestingly and surprisingly in some ways, the portfolio has performed well through the pandemic. And I think that's perhaps a reflection of the fact that we're investing in nimble growth companies who have the ability to adapt and change with a changing environment. I think also a focus on digital capability has helped a lot. So, for example, online retailers such as Baby Mori or Pastor Evangelist that I mentioned, or Wolf and Badger, have grown very strongly over the past year.
And over the last few years, have you had any failures?
We have, yes, and that is to be expected in portfolios of growth companies. So My Home Group is one, which is an online estate agent. Another this year has been Iris Fashion, which was a high street retailer. And again, to be expected in a diverse portfolio that businesses, that some of the portfolio will not succeed.
So how risky is it?
EIS is high risk. I think we look to mitigate that risk by focusing on scale-up businesses. So we don't invest in startups. We invest in businesses further down the growth path. And that helps us perhaps reduce the number of failures because we're focusing on businesses that have already proved up their business plan.
And for people who want to put money into an EIS this year, why should they invest with you?
Well, Guinness Asset Management is a highly respected and established fund manager. Our EIS fund is focused on scale-up businesses, which, as I say, helps mitigate risk. We're diversified. As a generalist, we look to invest across sectors and give investors at least 10 companies in their portfolio. And finally, we line up investments to be made in the current tax year. So as we close tranches, we have the investments ready to be made. And that means that investors who come to us know that their money will be put to work quickly in the current tax year.
Shane Galway of Guinness Asset Management, thank you very much.
Thank you, Alex.